What is happening in silver right now? Just days after one of the ugliest sell-offs traders have seen in weeks, silver has suddenly snapped higher on Monday, and the big question heading into Tuesday is whether this is the beginning of a real reversal, or just a temporary bounce inside a still broken market. That is the setup right now, and it is exactly why the silver market has become so dangerous, so emotional, and so important to watch. On the surface, Monday looks bullish. Price is higher. The selling pressure has eased. Traders are clearly stepping back into the market, but once you go underneath the headline, the picture becomes much more complicated. This is not a clean breakout in a calm environment. This is a rebound taking place after major chart damage, and it is happening while the US dollar remains firm and Treasury yields remain elevated. Two macro forces that usually act as headwinds for precious metals. That is why Tuesday matters so much. Tuesday may tell us whether Monday was the first real sign that silver has found support, or whether this was simply a relief rally before another wave of volatility. Let's start with what Monday's price action is actually telling us. Spot silver on investing.com was shown around 66.33, 64.925, and trading through a wide intraday range that stretched roughly from 63.766 to 67.1625. That is not the kind of range you see in a sleepy market. That is a market fighting for control. It tells you there is still real disagreement between buyers and sellers about where silver should be trading after last week's damage. COMEX-linked silver pricing was also back higher, with silver futures around the mid-66 area versus a previous close near 64.91. In plain English, Monday was a recovery day. Buyers showed up. The market refused to continue the straight-line collapse from last week. But a recovery day is not the same thing as a repaired trend. A bounce alone does not erase technical damage, and that is where a lot of traders get trapped. They see green on the screen, assume the worst is over, and forget that broken markets often rebound sharply before making traders prove that demand is real. And that brings us to the first core idea for Tuesday. Monday's move was important, but it was not yet decisive. The silver market has not earned the right to be called healthy just because it bounced for one session. In fact, some of the strongest counter-trend rallies happen after the most violent selling. Why? Because heavily sold markets attract dip buyers, short covering, algorithmic mean reversion flows, and bargain hunters all at once. A rebound can look extremely powerful without actually changing the larger structure. That is why smart traders are not asking, "Did silver bounce?" That answer is obvious. The real question is, can silver hold the rebound when the market opens again on Tuesday? If buyers are serious, they need follow-through. They need acceptance above the panic zone. They need to prove Monday was not just short covering and reflex buying. If they cannot do that, the entire move risks being reclassified as a dead cat bounce inside a larger unstable structure. What makes the rebound more interesting is that it happened in a macro environment that should not have been especially helpful for silver. The US dollar index was still hovering around 100.9, up slightly on the day, and the US 10-year Treasury yield was also elevated, with CNBC showing an open around 4.503%, a day high near 4.505%, a day low around 4.475%, and a previous close around 4.451%. Under normal conditions, that combination would not be ideal for precious metals. A firmer dollar makes dollar-denominated metals more expensive for global buyers, and higher yields raise the opportunity cost of holding non-yielding assets. So when silver rises anyway, it tells you something worth paying attention to. Either the market was severely oversold and due for a snapback, or there is a deeper bid under silver that is strong enough to overcome macro resistance, at least temporarily. Tuesday will help separate those two explanations. If silver continues higher despite the same macro pressure, that is meaningful. If it stalls immediately, then Monday may have been more about short-term exhaustion than a genuine turn in the underlying demand profile. This is why silver is such a difficult market to trade emotionally. It does not move in a straight line, and it almost never gives easy confirmation at the point where people most want certainty. On one hand, the chart recently looked terrible. Investing.com coverage noted that silver had plunged nearly 14.8% over the month and was testing key support around the 64.93 area. That kind of drawdown creates real chart damage. It destroys momentum. It shakes out weak hands. It forces leveraged longs to reduce exposure. It makes technical traders far more cautious on every bounce. On the other hand, silver is not just a chart. It is also a structural market with a supply and demand story behind it, and that story remains surprisingly tight. So you have this strange tension. The short-term tape can look awful, while the longer-term narrative still looks bullish. That tension is exactly what creates these high-volatility reversal tests. Monday did not resolve that contradiction. It simply moved the battle into a new phase. Now let's talk about why the longer-term silver story is still attracting serious attention, even after a brutal correction. Reuters reported that the global silver market deficit is expected to widen to 46.3 million ounces in 2026 from 40.3 million ounces in 2025. That matters because it reinforces the idea that silver is not merely a speculative momentum asset. It is also a market facing ongoing structural tightness. Deficits do not guarantee straight-up prices in the short run, but they do create a backdrop where sharp sell-offs can eventually attract strong buying interest, especially if investors believe physical supply remains constrained relative to demand. This is one reason silver can behave so violently. You get one group trading the macro tape, another group trading technical breakdowns, another group thinking about inflation and real rates, and another group anchored to the structural supply deficit story. All of those narratives can collide in the same week. So when silver crashes and then suddenly reverses, it is not random. It is the market trying to price all of those competing forces at once. This is also where a lot of commentary goes wrong. People try to explain silver using only one lens. They say it is all about the dollar, or all about inflation, or all about industrial demand, or all about technicals. In reality, silver is one of the purest multivariable markets out there. It trades partly like a precious metal, partly like an industrial input, partly like a speculative momentum instrument, and sometimes even like a proxy for wider risk sentiment. That means Monday's rebound cannot be understood in isolation. It happened after a steep technical washout. It happened while macro conditions remained unsupportive. It happened while the structural deficit narrative remained intact. And it happened in a broader environment where traders are watching cross-asset behavior for clues on whether Monday's move reflects a wider return in risk appetite or just an isolated metals rebound. That is why Tuesday is not merely another day on the calendar. It is a test of what story the market wants to emphasize next. Consider the broader risk backdrop. CoinDesk showed Bitcoin around $65,188 with 24-hour trading volume above $12 billion. Why does that matter for silver? Not because silver and Bitcoin are Tuesday is not just about silver's own candle. It is about context. Are other markets confirming a willingness to step back into risk, or is silver trying to rally alone into a still hostile backdrop? That question does not have a fully confirmed answer yet, but it absolutely belongs in the Tuesday game plan. Source: another reason Monday's rebound deserves attention is positioning. CME data indicated active engagement in silver futures rather than apathy. CME's silver market pages and related volume/open interest references show that traders are still heavily involved in the contract, and the user-supplied CME figures indicate volume around 26,400, open interest around 14,708, with open interest rising by roughly 404. Those are not numbers you associate with a market everyone has abandoned. Rising open interest around a major reversal zone can mean new positions are being built, and that makes Tuesday even more important. If Monday's bounce was accompanied by meaningful positioning activity, then the market may be setting up for a larger directional move. The problem is that open interest alone does not tell you whether those new positions are mostly bullish accumulation or fresh short exposure. It simply tells you the fight is active. The market is still alive, and traders are committing capital around this level. That means Tuesday could become a genuine decision day rather than a sleepy consolidation session. And then there is the delivery and COMEX plumbing angle, which gives this story a deeper layer than just chart watching. CME delivery notice material tied to June 2026 silver contracts showed settlement around 66.255, with intent and delivery dates clustered around June 18th and June 23rd. Why should anyone care about that? Because it reminds traders that silver is not only a screen-based speculative instrument. Underneath the volatility, there is a real delivery mechanism, a real futures ecosystem, and a real linkage between paper positioning and physical market expectations. When commentary focuses only on candles and ignores contract structure, it can miss the seriousness of the market. The delivery notice angle helps frame silver as a market where real metal, exchange mechanics, and speculative flows all interact. For a Tuesday outlook, this matters because if traders begin to believe the bounce has support not just from technical buyers, but from a deeper structural tightness narrative, confidence can build quickly. On the other hand, if the market treats the delivery backdrop as irrelevant and focuses purely on macro headwinds, then the rebound may struggle to attract sustained follow-through. So what exactly should traders and viewers be watching on Tuesday morning? First, watch whether silver can hold above the zone that Monday reclaimed after the panic selling. If Monday's recovery was real, buyers should defend weakness instead of allowing price to collapse straight back into the lower end of the range. A healthy reversal usually starts to show one very important behavior. Dips get bought faster than they were the session before. If Tuesday opens soft, but buyers quickly step in, that is constructive. If Tuesday opens flat and the market grinds higher with controlled pullbacks, that is even better. But if the market gives back Monday's gains too easily, that is a warning sign. It would suggest that the rebound was driven more by short covering than fresh conviction. In damaged markets, the burden of proof always sits with the bulls after a one-day reversal. Monday gave them a chance. Tuesday is where they must defend it. Second, watch the relationship between silver and the dollar. If the US dollar index remains firm or even strengthens modestly, yet silver still manages to stay bid, that would be one of the more encouraging signs for bulls. It would tell you that the silver market is finding support from its own internal dynamics, rather than relying entirely on macro relief. But if silver can only hold up while the dollar softens, then the rally is more fragile than it appears. That would mean silver is still dependent on outside help rather than standing on its own. The same logic applies to treasury yields. If yields remain elevated and silver continues to stabilize, that improves the quality of the bounce. If yields rise and silver immediately loses momentum, then macro gravity may still be stronger than the rebound narrative. Third, traders need to pay attention to the character of the tape, not just the closing number. This is one of the biggest mistakes retail traders make in highly volatile markets. They obsess over whether price is up or down at a single moment, but ignore how the session is unfolding. Is silver rallying on thin momentum and then getting rejected every time it approaches the highs? Is it building a base intraday and refusing to break lower? Is volume expanding into strength or only appearing on sell-offs? Those behavioral clues often matter more than the raw percentage change. A strong Tuesday for silver would not necessarily need a massive moonshot rally. What it really needs is stabilization with credibility, holding above reclaimed levels, absorbing intraday selling, and avoiding another collapse back toward the lower end of Monday's range. In a damaged market, stability can be more bullish than drama. Now there is also a psychological dimension here that should not be ignored. Last week's crash did more than move price lower. It damaged confidence. Confidence matters because silver is heavily sentiment-driven in the short term. When traders have just watched a violent breakdown, they do not instantly trust the first bounce. Some are looking to sell into strength because they got burned on the way down. Some are waiting for confirmation because they do not want to catch another false reversal. Some shorts are nervous because they know oversold markets can rip violently higher. That creates unstable order flow. The first rebound after a crash often faces emotional resistance because the market is still processing trauma. So even if silver has found a meaningful low, the recovery path may still be messy. That is another reason Tuesday is critical. It is the first chance for the market to begin rebuilding confidence after the initial shock response. If you are trying to explain this move to an audience in simple terms, here is the cleanest way to say it. Silver is bouncing because it fell too hard, too fast, into an area where buyers were willing to show up, but the larger market has not yet confirmed that the correction is over. That is the truth. Monday improved the immediate picture. It did not completely heal it. And until silver proves that it can build on this move, traders should be careful about confusing relief with resolution. In markets like this, every bullish candle feels like vindication, and every bearish candle feels like disaster. The reality is usually somewhere in between. Monday was a reversal attempt. Tuesday is the first real referendum on whether that attempt deserves trust. Let's dig even deeper into the bullish case for Tuesday. The bullish case says last week's collapse became too extreme relative to the still tight structural backdrop. It says silver had become oversold, support near the mid-64 area was meaningful, and Monday's recovery signaled that stronger hands were tighter pullbacks, more orderly intraday action, better hold of reclaimed levels, and reduced sensitivity to every small macro fluctuation. Bulls do not need perfection on Tuesday, they need proof that Monday was not a one-off. Now here is the bearish case. The bearish case says the chart is still damaged, macro conditions are still restrictive, and Monday's rebound was simply a reflex move after an oversold collapse. In this version of events, traders who bought the dip on Monday may quickly take profits, shorts may re-enter at better prices, and the market may fail to hold the reclaimed zone. The bears will argue that one green session after a crash means very little, unless resistance is decisively broken, and the rebound survives a retest. They will point to the firm dollar, elevated yields, and the fact that violent declines often produce equally violent but temporary bounces. They will say the structural supply story may be bullish over months or years, but it does not protect traders from sharp downside continuation in the short run. This bearish interpretation becomes much stronger if Tuesday sees weak follow-through, fast rejection from strength, or a slide back toward Monday's lower range. In other words, the bears are not defeated just because the screen turned green for a day. There is also a third possibility, and honestly it may be the most realistic near-term scenario. Tuesday turns into a messy, indecisive digestion day. That would mean silver does not collapse, but it also does not break out cleanly. Instead, it chops around while the market decides whether Monday was the beginning of repair or simply an interruption inside a broader unstable trend. This kind of session can frustrate everyone. Bulls feel disappointed because the rebound does not immediately explode higher. Bears feel frustrated because the market refuses to roll back over. But from a technical standpoint, a controlled digestion day after a violent reversal can still be constructive, especially if the market holds above the panic zone and gradually compresses volatility. After a market has been stretched to extremes, sometimes the healthiest thing it can do is stop being dramatic for a moment. A lot will depend on what kind of trader is in control. If fast money and short covering were the dominant forces on Monday, then Tuesday may struggle unless slower, more patient buyers step in. If institutional participants or larger macro traders begin to believe the washout created opportunity, then Tuesday could bring steadier support. If the market remains mostly tactical and nervous, then every rally attempt may still get sold quickly. That is why this is not just about up or down, it is about participation quality. Who is buying? Why are they buying? And are they willing to stay with the trade beyond a one-day rebound? The open interest angle matters here, because it signals the market is actively positioning, not merely drifting. One thing viewers should understand is that silver's longer-term tightness narrative and its short-term vulnerability can both be true at the same time. This is not a contradiction. It is normal for commodity markets, especially volatile ones. A structurally tight market can still suffer sharp liquidations when positioning gets crowded, when the dollar firms, when yields jump, or when risk appetite changes suddenly. The Reuters deficit story is important because it explains why silver attracts buying interest even after ugly sell-offs, but it does not erase the fact that traders must still survive the short-term swings. In other words, the long-term bull story can remain alive even while the short-term chart is still trying to repair itself. For Tuesday, that means traders should respect both realities. Do not dismiss the structural support, but do not assume it guarantees immediate upside either. And that is why the phrase high-stakes reversal test fits this market so well right now. Monday showed that sellers no longer had effortless control. That alone is important. But it did not yet show that buyers have taken control. There is a huge difference between stopping the bleeding and launching a new trend. Tuesday is the session that starts to answer which of those two processes is happening. If silver can hold firm, respect support, and attract follow-through, the market will start talking less about last week's crash and more about whether a new base is forming. If it cannot, then Monday will be remembered as a sharp but temporary relief move inside a still dangerous chart structure. So if I had to summarize the market heading into Tuesday in one sentence, it would be this. Silver has bounced hard from a damaged chart, but because that bounce is happening against a firm dollar and elevated yields, traders still need confirmation before calling it a real trend reversal. That is the entire story in one line. Monday gave the market hope. Tuesday decides whether that hope gets stronger, weaker, or simply delayed. For viewers trying to position themselves mentally, here's the practical takeaway. Do not go into Tuesday asking whether silver is definitely bullish or definitely bearish. That is the wrong mindset in a market like this. Go into Tuesday asking what the market is proving. Is it proving that buyers can defend levels? Is it proving that macro headwinds are still too strong? Is it proving that volatility is compressing after panic? Or is it proving that Monday's strength was shallow? Markets reward observation before conviction. Silver especially punishes people who rush to certainty after one dramatic move. Tuesday is not just another candle, it is evidence. And let's be honest, this is exactly why so many traders are obsessed with silver. It is never just price. It is story, macro, emotion, positioning, scarcity, momentum, fear, and speculation all meeting in one place. One week the chart looks unstoppable, the next week it looks broken, and then suddenly it rips higher when the macro backdrop says it should not. That is why silver commands attention. It is one of the few markets where a rebound can be both suspicious and exciting at the same time. Monday captured that perfectly. The market reversed higher, but it did so in a way that raised as many questions as it answered. So heading into Tuesday, the mission is simple. Watch whether silver can transform Monday's bounce into a base. Watch whether it can hold strength in the face of a firm dollar and elevated yields. Watch whether broader risk sentiment helps or hurts the move. Watch whether the tape looks like accumulation or exhaustion. And most of all, watch whether the market begins to act like the panic has passed. Because if it does, that may be the first step toward a more durable recovery. If it does not, then the bounce remains just that, a bounce. The bottom line is this. Silver is alive. Silver is active. Silver is not broken beyond repair, but it is not healed either. Monday mattered because it interrupted the collapse. Tuesday matters because it may reveal whether that interruption was the beginning of a real turn or just a pause before the next fight. And in markets like this, that distinction is everything. If silver holds, the conversation changes. If silver fails, the fear returns fast. That is the setup. That is the tension. And that is exactly what traders need to be ready for when Tuesday begins.